Hey there, let's continue with our series on basic options trading with the covered call today. The covered call is one of the most simple of all the option strategies, and it's the one, along with the short put, that people often start out with. And yes, I do know that the short put and covered call are synthetically the same trade, assuming the strikes are the same, of course. We haven't talked about synthetics yet, but we will in the near future. It's a very important topic, but it's a little more advanced, so let's just stick with the basics for now. Let's jump into the covered call. So I'm going to discuss what it is, why you might want to do it, some of the potential downsides of it, and we're also going to do a covered call. So today I'm recording this on Tuesday, September 2nd, 2025. So let's switch over to a presentation and get into it. So a covered call is simply the purchase of stock and selling a short call against that stock. So as we've discussed before, every options contract covers 100 shares. So you would buy 100 shares or a multiple of 100 shares of stock and sell the appropriate number of calls against it. Usually these calls will be out of the money. You can go in the money, of course, but then again, in a margin account, that's the same as selling a short out of the money put of the same strike price. So it'd be capitally more efficient to sell the put, as well as you'll have greater liquidity in out of the money options. So in that case, the put would be the better option to sell. So most people get into this as basically an enhancement to stock trading. So most people are familiar with buying stocks, even indirectly via mutual funds, or if you have a brokerage account, you almost certainly have purchased some stock in the past. Selling a call against existing stock or doing it as a single trade does a couple of things in your favor. It's going to lower your cost basis. So that means that effectively, the credit received from the call effectively lowers the purchase price of the stock. At least that's one way to consider it. As a result, your probability of profit increases because now you have a little bit of room to the downside. You have that call premium to protect you a little bit to the downside, as well as having some upside capital appreciation in the stock itself, and again, the credit that you've received for the call. So remember, when selling a call, the purchaser, so the person on the other side of that transaction, gets the right potentially to buy the stock, the underlying stock, at the strike price on or before that expiration date of that contract. Now, normally this isn't a problem for myself. I don't consider it a problem at all. But some people, when doing a covered call, do not want to sell their stocks for tax reasons, perhaps. Maybe they're just also big fans of the stock and they don't want to exit and re-enter it. But when doing a covered call, you might be forced to, if the holder of the call chooses to exercise it or it's in the money at expiration, you might be forced to give up a call. So I'm putting this as a downside of the trade. I don't see it as such, but some people do. Another potential issue some people have with it is the fact that you're capping your upside. As we'll see in a second, if the stock does rise above your strike price, the short call, and the stock will offset each other, and you will not be able to make any more money. And again, this is an expiration, and we're not talking about things like rolling the call out in time. But some people see it as a downside. I personally do not, but I've heard of some people regretting selling a call against their stock when that happens. So let's talk about the individual components, the stock itself, the short call, and then the combination of the two, the covered call. So most people intuitively understand buying stock. So in this hypothetical example, I have $100. We purchase a stock for exactly $100. Obviously, our payout graph is going to look like this. Our break-even point here is $100. So if the stock never moves, we don't make or lose any money. If it goes up $5, say we're going to make, where's my mouse? So we'll start here. If the stock goes up $5, we're going to make $5. So it's a dollar for dollar gain with rise of the stock. Likewise, dollar for dollar loss as the stock declines. So if you're mathematically inclined, the slope of this line is equal to 1. So the probability of profit on a stock trade, short term at least, is basically 50%. You can argue that there's an upward drift to the market and that over time, especially big name stocks or the ETFs that track the indices are going to have a slightly higher percent chance of going up than rather than down. But on the short term, everything is basically 50-50. Let's construct a similar plot for the short call. And again, I chose a hypothetical stock that was trading at $100. I sold theoretically in this model, I sold the 105 call, and I assumed I received a $5 credit for it. So we've talked about short calls before. So at expiration, if the stock is below my strike price of 105, we keep that $5. Our max profit is capped at the sale price, at the premium, at the credit of the premium received here. If the stock goes above our strike price at expiration, the slope of this line is exactly equal to -1. So we begin to lose money dollar for dollar with the decreasing or increasing value of the stock. But because we've collected a credit, in this example $5, our break-even point, where did my mouse go to? Here we are. My break-even point is actually at $110. So I do have some wiggle room, assuming that the stock breaches my strike price. Beyond $110, we begin losing money dollar for dollar. So let's talk about the combination of the two. So here again, we've sold a $100 stock. We sold the 105 call for $5. So let's talk about the case where the stock rises in value. So if the stock goes up, we begin to make money just as in the case of the raw stock trade, dollar for dollar. So we get this nice capital appreciation thing going on here. However, my cursor always jumps around when recording videos, and it really annoys me. I have no idea why it happens, but our profits are capped at the strike price. So because we've collected $5 in credit, and we have in this example potentially $5 of capital appreciation, the most we can make on this trade would be the $10. Beyond that, my mouse just jumped again. Where did the cursor go? Beyond that, we cannot make any more money. Okay, so let's talk about what happens on the downside. Because we've collected this $5 credit here, our break-even point is that credit away from our stock purchase price. So we bought the stock at $100, sold a $5 call. So our break-even point is at $95, which is cool. This is what gives us our higher probability of profit. So we can make money anytime the stock is basically above $95. And then below that, just like as in the case of the actual raw stock trade, we start to lose money dollar for dollar. And because we've lowered our break-even point, our probability of profit is above 50%. So the exact probability is going to depend on which strike you call. Closer to the money is going to give you a higher probability of profit. But the higher probability is going to limit your potential gains a little bit more. And if this graph happens to look a lot like the payout plot for a short put, there's a reason for that, and we'll go into it in a different video. So let's switch over to the platform and let's find something to do a covered call in. Volatility is not super high today, although the market has sold off, and that's caused a little bit of a pop in vol, but we'll come up with something. When doing covered calls, I prefer cheaper stocks, which in this market where we're basically at record highs, limits your choice. So you either have to do a trade that's very capital intensive in a more expensive stock, or try to find something that's on the cheaper end. So I think I'm going to look at AT&T today. So let's switch over to the platform and see what we can do. So here we are in Tasty Trade. The market is down today. The E-mini S&P futures are down roughly 1%, which is a decent sized move, I guess. But I'm interested in trading AT&T, which goes under the ticker symbol T, not the tickle symbol, the ticker symbol T. It's roughly a $29 stock. The IV rank is not great, but as I said earlier, I prefer to do this in cheaper stocks. And just for the sake of the video, I will actually do a covered call in AT&T. So I'm going to go out to the October option chain because it's the closest to 45 days. In fact, right now it is exactly 45 days to expiration. And I'm going to buy, let's see, I'm going to click the ask price to buy 100 shares of stock. So if you come down here, I'm buying 100 shares of stock roughly for $29.05, and I want to sell a call. So the 20 to 30 delta call. Well, the 31 is the 31 strike is roughly 20 delta, 19 delta. The next one here, this is 34 delta. Which one? I think I'm going to go closer to the money. So this is going to give me a slightly higher probability of profit. I'm going to collect roughly 40 something cents for that call. So that lowers my break-even price by that premium that I've collected. So you can see now my break-even point goes down below the actual stock price, and I make money up to infinity. However, my gains are capped. So the most I can make here is roughly this dollar difference between the stock price and my strike price, plus the credit received. So call it $1.40 just to keep the arithmetic simple. So let's route this trade, see if I get filled. Done. That's a covered call. So that's it. It's a covered call. It's a pretty basic trade. It's as I said before, it's a trade that a lot of people start off with doing their first foray into options. It's a nice high probability trade. It's a good way of enhancing the value of stock that you already own. In future videos, I'll show a way to do covered calls, or I'm going to talk about synthetics first, but there are trades that very much mimic the behavior of a covered call and are much less capital intensive. So we're going to go over those in a future video. If you have any questions, leave them in the comments, please. If you have any suggested topics, also again in the comments. And until next time, see ya.